Slippage is a common concept in digital asset trading that impacts the final price you pay for a token. Slippage refers to the difference between the price you expect to get and the price you actually receive when a transaction executes. In fast-moving markets, you might see slippage of 0.5% or more, meaning you get slightly fewer tokens than you anticipated. This happens primarily when there are not enough buyers or sellers at your target price, or when the market price moves while your order processes. Slippage is the hidden cost of market orders, which prioritize getting the trade done immediately over getting a specific price. As your order size grows, you consume more of the available liquidity, which naturally pushes your average transaction price further from the starting point. Experienced traders often use limit orders to specify the exact price they are willing to pay, which helps avoid unexpected slippage. Understanding market mechanics is key to navigating exchanges safely. Thanks for watching, and remember that this is educational content, not financial advice.